I just made the most controversial decision of my investing career. Last month, I did something that would make every financial advisor cringe. I sold every single bond in my portfolio. All of them. Gone. And I replaced them with just 2 ETFs that could literally let me retire 5 years earlier than I originally planned. Now, before you click away thinking I've lost my mind, let me show you exactly what happened in 2025. While my old bond portfolio was essentially treading water, one of these ETFs delivered a staggering 10.65% return, and the other, well, let's just say it taught me a valuable lesson about diversification. But here's the kicker. Even the underperformer has a secret weapon that could accelerate your retirement timeline in ways bonds simply cannot match. This wasn't just about chasing performance. This was about my entire financial future. I realized that while I was playing it safe with bonds, I was actually taking the biggest risk of all, the risk of never being able to retire. By the end of this video, you'll see the exact numbers that changed my mind, understand why the Federal Reserve's upcoming moves make this strategy even more compelling, and discover how this approach could shave half a decade off your own path to financial independence. Let me tell you about the moment I realized bonds were actually sabotaging my retirement. I was reviewing my portfolio last year, feeling pretty good about my conservative allocation. I had a solid chunk in bonds because, that's what you're supposed to do for stability and income, right? But then I started doing the math on my retirement timeline, and I had this sinking realization. My bond investments were barely keeping pace with inflation, and in some cases, they weren't even doing that. Here's the brutal truth about bonds right now. The Federal Reserve's interest rate volatility has turned the bond market into a roller coaster, but not the fun kind. We've seen rates swing dramatically, crushing bond values when rates rise and leaving investors in this perpetual state of uncertainty. And even when bonds do perform well, what are we talking about? Maybe 2 to 3% annually if you're lucky. Meanwhile, inflation is eating away at your purchasing power every single day. The wake-up call came when I calculated how long it would take me to reach my retirement goal with my current bond-heavy strategy. The numbers were depressing. At the rate I was going, I'd be working well into my 70s, maybe even beyond. That's when it hit me. I was taking the biggest risk of all by playing it safe. I was risking my time, my freedom, and my ability to enjoy retirement while I'm still healthy and young enough to make the most of it. Something had to change. And that's when I discovered these 2 ETFs that completely transformed my thinking about income investing. Meet my first replacement, SCHD, the Schwab U.S. Dividend Equity ETF. This isn't just another dividend fund. This is a carefully engineered income machine that manages a massive $72.2 billion in assets while charging an incredibly low expense ratio of just 0.06%. But here's what really caught my attention. SCHD is currently yielding 3.80%. Let me repeat that. 3.80% yield. Most bonds right now can't even dream of matching that kind of income generation. What makes SCHD special is its approach to dividend investing. Instead of just grabbing any company that pays a dividend, SCHD tracks the Dow Jones U.S. Dividend 100 Index, which screens companies based on fundamental strength. We're talking about a concentrated portfolio of only 103 holdings, but these aren't just any holdings. These are dividend aristocrats. Companies like AbbVie, Chevron, Home Depot, Altria, and PepsiCo. These aren't trendy tech stocks that might disappear tomorrow. These are established, cash-generating businesses that have been paying and growing dividends for decades. The fund's sector allocation tells you everything you need to know about its defensive nature. Nearly 20% is in energy, almost 19% in consumer staples, and over 15% in healthcare. These are the sectors that keep producing income regardless of what's happening in the broader economy. And the track record speaks for itself. Over the past 5 years, SCHD has delivered an annualized return of 7.45%. That's more than double what most bond strategies have managed. But here's where the story gets really interesting. Meet VYM, the Vanguard High Dividend Yield Index ETF, and prepare to have your mind blown. While SCHD was having a modest year in 2025 with a 0.29% return, VYM absolutely exploded with a 10.65% year-to-date performance. This is a fund that manages even more money than SCHD. We're talking $79.5 billion, while maintaining the same rock-bottom 0.06% expense ratio. VYM takes a completely different approach than SCHD. Instead of concentrating on just over 100 companies, VYM spreads its bets across 583 holdings. This massive diversification means you're getting exposure to dividend-paying companies across the entire market spectrum. The top holding, Broadcom, makes up 6.84% of the portfolio and has been a major driver of those incredible 2025 returns. But the beauty of VYM is that no single company dominates the fund. The top 10 holdings represent only about 26% of the total portfolio. What really sets VYM apart is its long-term track record. We're looking at an annualized return of 11.08% over the past 5 years. Think about that for a moment. While bonds were delivering 2 to 3% annually, VYM was compounding wealth at more than 11% per year. The fund has grown from $83.46 per share in September 2020 to $141.12 in September 2025. That's a total return of over 69% in 5 years. Compare that to SCHD's still impressive but more modest 43% total return over the same period. Okay, let's get real about the numbers because this is where the story becomes absolutely compelling. When you look at the 5-year performance data, the difference between these ETFs and traditional bonds isn't just significant, it's life-changing. VYM's 11.08% annualized return over 5 years represents the kind of wealth-building power that can completely transform your retirement timeline. Let me put this in perspective with some concrete math. If you had invested $100,000 in a typical bond portfolio 5 years ago, earning around 3% annually, you'd have about $116,000 today. Not terrible, but hardly exciting. That same $100,000 in VYM would be worth approximately $168,000 today. And in SCHD, you'd be looking at around $143,000. We're talking about tens of thousands of dollars in additional wealth from making this single strategic shift. But here's where it gets even more interesting. The performance gap in 2025 between VYM and SCHD teaches us something crucial about diversification and sector allocation. VYM's broad market exposure, particularly its significant position in technology through holdings like Broadcom, allowed it to capture the tech rally that drove markets higher. Meanwhile, SCHD's more defensive positioning in energy and consumer staples, while providing stability, meant it missed out on much of the growth. This performance difference isn't just about bragging rights, it's about compound growth and time value of money. When you're trying to reach financial independence, every percentage point of additional return can shave years off your working timeline. The difference between earning 7% annually versus 11% annually is enormous when compounded over decades. And then there's the tax efficiency advantage that most people completely overlook. When you receive interest from bonds, that income is taxed as ordinary income, which could be as high as 37% for high earners. But qualified dividends from these ETFs are taxed at the much lower capital gains rates, typically 15% or 20% for most investors. This means more of your income stays in your pocket to compound and grow. The dividend growth component is another factor that bonds simply cannot match. While bond payments are fixed, the companies in these ETFs typically increase their dividends over time. This provides a natural hedge against inflation that bonds completely lack. When the cost of living goes up, your dividend income has the potential to grow along with it. Here's how this strategy fundamentally changes the retirement timeline equation. Traditional retirement planning relies heavily on the 4% withdrawal rule, which suggests you can safely withdraw 4% of your portfolio annually without depleting your principal. But what if instead of withdrawing from your principal, you could live primarily off the dividends your investments generate? SCHD's current 3.80% yield means that for every $100,000 invested, you're receiving $3,800 annually in dividend income without touching your principal. But the real magic happens when you combine this with VYM's growth potential. While SCHD provides the immediate income replacement, VYM's superior long-term returns help build the portfolio value that generates even more future income. The Federal Reserve's anticipated rate cuts create an additional tailwind for this strategy. As rates come down, bonds become less competitive with dividend-paying stocks, potentially driving more capital into funds like SCHD and VYM. Lower interest rates also reduce borrowing costs for the companies in these funds, potentially boosting their profitability and ability to increase dividends over time. Here's a realistic scenario of how this could accelerate retirement by 5 years. Let's say you're 35 years old with $200,000 saved, and you're adding $30,000 annually to your investments. With a traditional bond-heavy portfolio earning 4% annually, you'd reach $1 million portfolio at age 55. But with this SCHD and VYM strategy, assuming a blended return of around 9%, you could reach that same $1 million milestone by age 50. That's 5 years of your life back. The beauty of this approach is the flexibility it provides. You can allocate more heavily toward SCHD if you need higher current income, or weight more toward VYM if you're still in the accumulation phase and can tolerate some additional volatility for higher growth potential. As you get closer to retirement, you might shift the allocation to favor SCHD's higher yield for more predictable income. The quarterly distribution schedules of both funds provide regular cash flow, which can be reinvested during the accumulation phase or used for living expenses once you reach financial independence. Unlike the systematic withdrawals required with traditional retirement portfolios, dividend-focused strategies let you preserve your principal while living off the income it generates. Now, let's be brutally honest about the risks because I'm not here to sell you some fantasy. The biggest risk you're taking with this strategy is volatility. These are equity-based investments, which means they're going to swing up and down with the stock market. While SCHD and VYM are more defensive than growth stocks, they're still going to be more volatile than bonds. During market downturns, you could see significant temporary declines in your portfolio value. SCHD's concentrated approach presents sector-specific risks that we saw play out in 2025. With nearly 40% of the fund in energy and consumer staples, economic changes affecting these sectors can significantly impact performance. VYM's broader diversification helps mitigate this risk, but it doesn't eliminate equity market exposure entirely. There's also the dividend sustainability risk that bond investors don't face. Unlike bond interest payments, dividends are not guaranteed. During severe economic downturns, companies can and do cut their dividends to preserve cash. While both SCHD and VYM focus on quality companies with strong dividend-paying histories, no dividend is truly safe if economic conditions deteriorate enough. Interest rate sensitivity is another factor to consider. Paradoxically, dividend-paying stocks can sometimes decline when interest rates rise significantly as bonds become more competitive with dividend yields. This makes timing and economic awareness important factors in implementing this strategy successfully. So here's what I learned from making this dramatic shift from bonds to dividend ETFs. The numbers don't lie. VYM's 10.65% performance in 2025 versus SCHD's 0.29% shows the importance of diversification, but both funds demonstrate superior long-term wealth-building potential compared to bonds. SCHD's 3.80% yield provides immediate income that beats most bonds, while VYM's 11% historical annualized returns offer the growth component essential for early retirement. The data supports the 5-year acceleration potential, but success depends on your risk tolerance and ability to stay invested during market volatility. Current market conditions, including anticipated Fed rate cuts, create favorable conditions for dividend ETFs, but the increased volatility means this strategy isn't for everyone. Here's my bottom line. After analyzing all the data and making this transition myself, I'm more confident in my retirement timeline than I've ever been. The combination of current income and growth potential these ETFs provide addresses the fundamental problem with bonds. They simply don't generate enough return to build real wealth in today's environment. This isn't financial advice, and you need to do your own research based on your specific situation. But if you're tired of watching your bond investments barely keep pace with inflation while your retirement date keeps moving further away, these two ETFs might be worth serious consideration. Sometimes the biggest risk is playing it too safe. And for me, the risk of never being able to retire was far greater than the volatility risk of these dividend-focused strategies. Which ETF resonates more with your strategy? SCHD's 3.80% yield for immediate income, or VYM's 11% historical growth potential for long-term wealth building? Let me know in the comments below. And if this analysis was helpful, make sure to subscribe for more early retirement strategies.